Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a concept that is on capitalization versus expensing. We'll be learning the differences on the same with few examples. So let's begin. Now, first of all, capitalization versus expenses. Capitalization is basically defining as recording of the cost like an asset. So in spite of an expense, such a consideration is done while cost is not been believed to be completely disbursed over the existing period of instead in a prolonged time period. So removing a key item from the company's income statement while consequently including it into the firm's balance sheet for just showing the depreciation as a key charge contrary to the profits, which may lead to expanding the profit significantly. As you can see, there is a transaction over here, 3.8 billion 2001 expenditure lineup. The regulator, what is required as per the GAAP over here, what the WorldCom did exactly. The WorldCom declared the bankruptcy in July 2002. The chief accounting and finance executive were charged with the fraud. What exactly they did over here, as per the regulators, as per the norms, the same should have been capitalized. So that must have been had to be treated as operating expenses. That means it had to hit the P&L account. Rather than that, what they did, just not to show that amount as the expense which would have reduced the profit, they capitalized. And what was the financial impact of the same? The income over here should have been deducted by 3.818 billion. But over here, the 3.8 billion was capitalized, right, in the balance sheet, and due to which there was a window dressing. So this is why it is really very important from this very example, which is WorldCom that happened in July 2002. We need to learn something from this, and we need to be very vigilant regarding this particular concept. Considering the telecom giant WorldCom, whose major portion of the expenses comprised of operating expenditures, referred to as a line cost. Such costs were remuneration offered to indigenous phone companies for using their phone lines. In general, the line expenditure were treated normally like usual operating expenditure. However, it was assumed that a part of this expenditure was real investments in undiscovered market and are not expected to pay off for this several years to come. So this logic was employed by company's CFO Scott Swivelin, who started capitalizing this particular thing. As you can see, his firm's line cost during the later part of the 1990s, and therefore this expenditure were removed from the company's income statement and thereby increasing the profits of the company by several $1 billion. And across Wall Street, it looked like WorldCom suddenly started delivering profits even in downturn, and that was skipped by the industry experts until a major collapse that was witnessed later. So WorldCom declared bankruptcy in July 2002. Now let's begin the concept of capitalization versus expensing. Capitalization is basically recording an expense as an asset, right? This is done when it is believed that the benefits of such expense will be delivered for an extended period of time. Like for instance, let's say there is office goods, right, are believed to get spent fast, and thereby they are treated to be spent simultaneously. A vehicle is recorded. A vehicle is recorded like an immovable asset and expected to get spent over significantly over a long time period via depreciation, as this vehicle is expected to get consumed over a much longer time period compared to the office supplies. So expenses in the other hand is referred to as the assumption of an expenditure like an operating expense instead of capital investment. So considering taxation, an expense is reduced from the income directly, whereas an asset is depreciated over a business undertaken a series of reductions over the asset's useful life. Let's take one example of capitalization example. If let's say a company buys a car, okay, and that car is worth, let's say, $50,000, and that happened, let's say, in 2017. Now since the company has paid for the expenses, should we take the expense of 50,000 over here, as you can see in the income statement of 2017, or should we record this expense somewhere else? You got it. So let's assume that car has a useful life of, let's say, 10 years. This means that the company can derive the benefit of the car until the 10th year. Therefore, it will not be wise to record all the expenditure at once in the income statement. So we should capitalize this expenditure of 50,000 and reduce it by the amount of the value derived each year. So the above discussed expense all through the account accounting is referred to as depreciation. So let's see some of the summarization part of capitalization versus expenses. Let's see some of the key differences, how things work out. I'm just going to write cap and over here as expenses, XP. So the major suggestions on the choose between expensing versus capitalizing is while reporting profits every period. So if one chooses to capitalize any assets as against expensing, it leads to a greater profit while successively leading to greater taxes as well as improved business value. However, if we select to go for expensing for any assets rather than its capitalization, would deliver just opposite results. As you can see, the cost incurred in case of capitalization, it will go to balance sheet. The net income, depreciation or amortization, and over here there will be a cash outflow. So the balance sheet impact will be there'll be hit on the asset side, there will be increase in the assets, and there'll be a cash outflow if it has been expensed. In the income statement, the net income, that is in the P&L, profit and loss account, there'll be an expense and there'll be a cash outflow. The CFI inflow, cash flow of investment activity, there'll be an outflow. Over here there'll be a cash flow operation activity, there'll be an outflow. So let's get back to over here. First, in case of capitalization, the cost, this is the difference we are doing it. The cost recorded is over here is as an asset of the company, and over here the cost recorded as an operating expenditure on the income statement. Second, while capitalizing any cost and later amortizing, it results in the cost distributed over a longer period of time. And over here, under the normal conditions, complete expense is incurred while making any purchases. Let's talk about the third point. While capitalizing any cost, any later amortizing, it results in the cost distributed over a long period of time. And over here, under normal conditions, complete expense is incurred while making any purchases. Fourth point, for asset capitalization, it should possess valuable life that covers more than existing years. So this assets must be capable of running the entire business. However, any inventory being sold to customer does not qualify to become capital assets. Like fixed assets are generally considered like equipment or range of intangible assets like patent, copyright, usually like outright to be depreciated as against being amortized. While in this case, while starting a purchasing business, IRS enables one to remuneration the business beginning or procurement cost. The expenditure made to consume a patent, copyright, trademark or comparable rational property may be amortized. So one may repay goodwill, that is generally expected to be realized during the sales owing to the ongoing usage of the reputation or name of any product or business that you intend to acquire. And generally IRS allows one to repay geological expenditures that are intended to develop or locate petroleum wells as across the United States, and one could even repay the research expenditures. The fifth point, that is a general rule. Any procurement beyond a specific dollar range is counted to be a capital expenditure or capitalization. Now, over here, a general rule, purchasing lesser than the allocated dollar range is treated as an operating expenditure. Finally, sixth point, as in accounting, upon an asset's capitalization is assumed that the asset is still having an economic value and is believed to be the prospective period and thus is mentioned over the balance sheet. While in case of expenditure, an expense comprises of the core economic costs that are incurred by any business through daily operations for earning revenue. So every business is permitted to write off all the tax deductible expenditure on their specific returns for income tax to minimize the taxable income. Hence, the tax liability, most common business expenditure comprises of like supply payments, wages to employees, factory lease, and depreciation equipment.